You're watching the India Development Debate. I'm Tamanna Inamdar, and what a news day it has been. We have a lot lined up for you today. Government's advance GDP estimate for FY20 is at 5%. It's sombering news. Less than 3 weeks before the Modi government's first full-fledged budget in its second term. So the advanced GDP estimate has pegged growth at 5% in FY20. It's the lowest level since 2009. Now, 5% growth for this year has been widely expected, and it's possible the actual numbers could be marginally lower than the estimates. It has happened in the past. But it's not just the 5% number that is concerning, it's the details. Private consumption is expected to fall sharply to 5.8% versus 8.1% last year. Manufacturing is expected to drop to 2% from 6.9%. And the most worrying sign yet, gross fixed capital formation is likely to plunge to 1% from 10%. And these are government estimates. The question is there a plan for revival? To speak more on this, I am joined now by R. Gopalan, former Secretary, Department of Economic Affairs, former Finance Secretary, Sameer Narang, Chief Economist of Bank of Baroda, Aditi Nair, Principal Economist at ICRA. Welcome to all of you, and thank you for speaking with us today. Mr. Gopalan, let me begin by just getting your broad overview on the advanced GDP estimates. And of course, further in the debate, we will talk about the broader economic picture and what the government can do. But let's start with the numbers you've seen today.
Yeah, as I see it, the growth is, estimated to be 5%, and as I also agree with you that it can be less than 5% also. Most importantly, worrying things are the gross fixed capital formation, which has fallen very, very steeply. Then private final consumption expenditure is going to go down. Then you have the manufacturing dropping, as you mentioned, significantly. Your financial sector, the financial, real estate and professional services have dropped, as also the trade, hotels and communication services. Construction has also fallen significantly. Now, these are all and exports and imports have also shrank very sharply, and probably these things will indicate certainly there is a big slowdown at this point in time. This will have implications for collection of revenue, also to fiscal deficit. It also will have implications for your, what is the nominal growth rate as well as nominal GDP, which we are going to have at this point in time. All of them will undergo sharp revision, and if you look at fiscal deficit as a number, as a percentage, obviously this will undergo a change, and one needs to see how expenditure is going to be cut, which will once again compress the economy and therefore on the growth rate. So 4.7 to 4.8 is some estimate which I think is a good thing, which I think the economy is going to end at. It's a sharp decline.
It's a sharp decline. And now, explain to me your perspective, Sameer, on the gross fixed capital formation number. That's the most stark, 10% to 1%. What are the reasons you see? What are your reading on this number and the other broad numbers today as well? What kind of a picture does it paint for us for the second half?
If you look at the H1 number, the gross fixed capital formation in Q2 was running at 1%. In Q1, it was a tad bit higher. So you're absolutely right. H2 may be a situation in which you are going to see the government or the CS was estimating a dip in the overall GFCF in terms of growth in H2 from what we've seen in H1, because the estimate is only 1% now. And the dip is driven both by the state government. If you look at the state government spending, it was far lower in terms of capex and infrastructure spending in the data that is available up to H1. So that has been one of the drivers of lower capex. In addition to that, if you look at the private sector project announcements, though there is an uptick in December, but up to H1, the numbers have been actually decelerating very, very sharply. So that also ties up with the capacity utilization. So the capacity utilization in the economy has dropped to 69 odd %, which is the number that you've seen in 2009 or thereabouts. Because of lower demand, both exports and domestic demand. So because of lower demand, you've seen and the existing capacity is not getting utilized, and the private sector is not interested in spending right now till such time the capacity utilization levels improve. So that is in nutshell the story.
It's a dismal story, Aditi. I want to get your perspective on it first before we come to more details and broaden the debate. What is the kind of picture that the numbers today are painting? And let's put it in the context of the fact that we've known that there is a slowdown coming, and we're in the middle of it for quite some time now. The government has also taken a number of steps to try and ease the situation. Do these advance estimates indicate that much more needs to be done, and the steps taken so far are not necessarily showing impact as of now?
Thanks, Tamanna. So, I'd like to put it this way, that we've known very well that we're in the middle of a slowdown, and in Q2 the slowdown worsened. Now actually what we're looking for in terms of all the lead indicators that we're getting for Q3 FY20 is really whether the slowdown is going to worsen, or is there some hope of a pickup coming through in Q3 FY20. And I'm actually quite hopeful, looking at the various real sector indicators that we have, that things are beginning to turn around. We saw that in November, and the very early lead indicators that we have for December are indicating that that trend is continuing. So we have things like the port cargo traffic, we have Coal India's production numbers, both of which have shown a healthy turnaround to a moderate growth after many months of contraction. And even things like electricity generation continuing to contract, but at a much narrower pace than what was the case earlier. The PMI numbers have also been quite good for December, both for manufacturing and services. CMI data as well, broadly giving hopeful signs. The Rabi sowing reservoir levels all suggesting that we're going to get a good Rabi harvest coming through in Q4 of FY20 and Q1 of FY21, which should support rural sentiment and at least lead to some pickup in consumption growth in these quarters. So overall, I would say that the biggest disappointment I am seeing in the more disaggregated data that we have so far for Q3, which is now the quarter for which we are awaiting growth at the end of next month, is really that government spending growth has slowed down. So what we've seen is a very different picture through the different quarters of FY20. Particularly for Government of India, we saw a slowdown in spending growth in Q1 while the elections were on, followed by a huge catch-up in Q2, which really pushed up the GDP growth, or I should say prevented GDP growth from falling further in that quarter. After that, in Q3, we have data for October, November, and what we've seen is that the revenue expenditure growth has slowed down, and capital expenditure has contracted in these 2 months. So that, I would say, is a worrying sign. But other than that, we are getting hopeful signs coming in from a lot of the real sector lead indicators for this quarter.
Okay.
The extent to which revenue considerations force expenditure cuts in Q4 is really going to be quite critical now in assessing the full year growth forecast.
This coming at a time when there have been reports since last evening that the Indian government is likely to cut its spends massively by up to 2 trillion rupees this fisc, and we'll have to see if that happens. But Aditi, they're striking an optimistic note. I want to open up the debate and ask if the others agree. Mr. Gopalan, do you see silver lining there somewhere? Because the biggest question people are asking, and those who are watching this show, and maybe not everyone follows the macro numbers that closely, but the biggest question people are asking is that, is the worst yet to come, or are we at the bottom of the cycle? What are the numbers telling you?
So the problem is whether we reach the bottom or not. My view is that from some of the numbers which are coming up, like Aditi mentioned a few numbers, I don't know whether they are, in a sense, they are seasonal, or whether they are, a trend which shows we have bottomed out or not. That is something not very clear at this point in time. The core sector growth, as we saw, has contracted, but by less a percentage as compared to the previous months. But there are other areas where I'm not still getting good numbers on the rural side. The rural wages side, though it has gone up a little bit, thanks to agricultural rabi activities having picked up a little bit, I need to see how that is going to be sustained if government expenditure is going to contract significantly in the entire year. I am told the expenditure is going to be down by about 2.6 to 2.7 trillion in Indian rupees.
Yeah.
And I mean, accounting for that is coming out thanks to the government not increasing the borrowing numbers.
Right. Samir, how do you look at...
And therefore, I get the feeling that...
Okay. Samir, how do you look at the situation coming in? And let me ask the very simple question that I started the show with. So now we know beyond a doubt that we are in the middle of a slowdown. It is a painful period. Do you see a clear roadmap for revival? And what do you think could be a clear roadmap for revival?
Right. So I think first let's look at the numbers itself, and that will give you some idea of the roadmap on the numbers. This year, say growth is going to be give or take 10 or 20 basis points at 5% GDP terms. So next year, what do you expect? Next year, we expect it to settle at around about 5.7 or 5.8%. And thereafter, in FY22 is when we expect it to go back to the FY19 level at 6.6 or thereabouts. So it's a step up every year, but it's a gradual step up. And the numbers that we've discussed earlier in the show just show that there is some cyclical revival that is playing out. Structurally, for growth to move back to 7%, we require more investments, and those investments have to come from government. And the government's plan in terms of the roadmap for stepping up that is to monetize its assets, such as Concor or Bharat Petroleum. So what you're going to see is government monetizing its assets at the same time and reinvesting those proceeds in capital creation, and that will lead to the positive cycle of private sector investments as well, because you would see that private sector investments go hand in hand with government investments. When government spends more on infrastructure, be it state or center, the private sector capex also picks up, cement output picks up, steel output picks up. So all of that will come together and lead to higher growth. But it's a step up every year as government monetizes and reinvests its proceeds back. You'll see growth picking up. So that's how we see the roadmap in the next 2 years.
Okay. Aditi, you want to come in on that point? The roadmap to revival. Roadmap to revival. Now, you've struck a optimistic note. R. Gopalan is not so sure. We don't know where the bottom is. We're hoping things improve. So, two-part question. One is, why do you think private appetite is still so hampered? What is the underlying reason? Because no one's been able to figure that yet. And you kind of have to if you need a revival plan. In your view, do you think this government has a clear revival plan?
So let me offer a few different perspectives. One, as far as the private sector investment activity is concerned, clearly capacity utilization is at a very low level, and with the cyclical upturn that we are expecting in consumption in over the next couple of quarters, we're only going to get back to moderately healthy levels of capacity utilization. So clearly large scale capacity expansion by the private sector is a ways away. We shouldn't be basing any growth forecasts or building in any optimism of that being a driver of growth anytime soon. So I think that's pretty clear. Secondly, as far as infrastructure is concerned, we need to be clear on what is the roadmap for financing to really understand how realistic it is to expect infrastructure spending by the central and the state governments to emerge as a big driver of a growth pickup in the next couple of years. Here I think central government revenue issues are well understood, but on the state government side, a couple of things. We're already in the middle of the 5-year transition period of the GST compensation, and states really need to start looking ahead to how they're going to manage their finances after this compensation period ends. That's going to be one big thing that we need to look at. What the 15th Finance Commission is going to indicate in terms of sharing of taxes between the center and the states remains an open question at this point in time. That's another thing that could really impact what the state's tax collections look like. And we've got that corporate tax cut which has happened. In any case, growth is very subdued for Government of India's tax collections this year. But how soon is this going to engender a buoyancy in overall tax collections? Because if it doesn't, then we are looking at a period of lower revenue growth or lower, tighter revenue conditions going ahead. And that is going to constrain how much space is really available for building up of infrastructure. So I think financing is, the roadmap for financing is something that we're really looking forward to be able to assess how quickly we can get back to a higher growth trajectory. I would tend to agree that at this point in time, we are looking at growth getting back to 6 to 6.5% at best over the next couple of years. So we're not building in a case of growth being significantly higher than that. But if financing were not to be a constraint, then clearly infrastructure can drive a growth which is at a much higher level.
One, talking about a revival plan and what the government needs to do. Samir has, spoken about the disinvestment point of view. The question now is there are some perspectives coming in that the government needs to spend its way out of this situation. Do you think that there is bandwidth for that? And if we go by this report that there will be a cut in spend, do you think that that is the right direction? Or at this point, should we really stop bothering too much about this fiscal deficit red line that we've drawn?
Well, this is a very significant question because how are we going to create the rural demand or the consumer demand we are going to create at the rural level, which is not happening because your expenditure on rural housing or your rural infrastructure, Gram Sadak Yojanas or Nrega, those kind of expenditure which is supposed to kickstart the rural demand at this point in time is not increasing. It is rather in the last year's level or little less. So how do you plan to kickstart the rural demand at this point in time? I do not know. Unless you are able to take these measures immediately, it is not going to help. But coming to your fiscal deficit, issues, you have to cut the numbers to some extent, but the question is, where do you do a fine balance? A 3.3 to 4%, in my view, is not a great problem. Markets have factored in that there is going to be a slippage. So I don't think from 3.3 to 4 is not going to be a big problem. In any case, government has, by sleight of hand, does a lot of off-budget, collections they do. Yeah. They go to the market and raise the money. So my view is that a small slippage is not a problem, provided this money is spent on the works, as I mentioned, about the rural housing, rural infrastructure, and those kind of activities which can kickstart, because fiscally, once you find that these kind of investments are able to give a greater push to GDP as compared to spending on revenue expenditure. The fiscal multipliers that way on infrastructure are far better, and that is proved under Indian conditions.
Okay. Aditi, you want to come in as we wrap this on your prescription of what you'd hope to see? And of course, we're getting into budget season. We know there are always limitations to what can be done on that one budget day. But in terms of signaling, what do you hope to see?
So I would say 3 or 4 things. I agree that if we have to have a fiscal slippage, it's possibly better to go about with a higher expenditure rather than tax cuts. I'm not sure what the multiplier impact of cutting personal income tax is going to be at this point in time. So possibly I would agree with Mr. Gopalan that we do need to look at higher expenditure and targeted expenditure that's going to have the highest multiplier impact in terms of boosting demand and core sector demand as well. In terms of what we would like to see in the budget, a transparent acknowledgement of some of the subsidies, spillovers, the off-budget items would be appreciated by the market. I think most market participants are building in that there is going to be some amount of fiscal slippage given the kind of shortfalls that we are penciling in for the gross tax revenues of the Government of India. So that's not going to be very surprising, but I think that that better clarity in terms of the subsidy spillovers, for example, is something that would be appreciated.
Well, here's hoping that there is a clearer, revival path that the government sets up. And here's hoping that things definitely improve. The figures don't look promising right now as far as these advanced estimates are concerned. I want to thank all of you for joining us on the big debate this evening.